Everyone thinks they know how the global financial system works. The Federal Reserve prints dollars. Banks borrow them. Countries trade with them. Simple, right? But what if I told you there exists a hidden mechanism? A backdoor pipeline of unlimited US dollars. A mechanism that can rescue entire countries overnight, save collapsing financial systems, or quietly decide which nations stay afloat and which ones drown. A mechanism so powerful, even most economists don't fully understand it. And here's the real twist. It doesn't appear on your currency, your banknote, or your paycheck, but it decides the fate of all three. Today, we're uncovering the world of central bank swap lines, the secret plumbing behind global finance, and the reason the US dollar is far more powerful, far more entrenched, and far more unavoidable than anyone realizes. Stay with me because what you're about to learn will change the way you see the world. To understand what swap lines reveal, we need to travel back to a time before they existed, a time when the global financial system ran on a single assumption. Countries could stabilize their currencies on their own. The US had the dollar, Europe had the Deutschmark, the pound, the franc, Japan had the yen, and each central bank believed they could defend their currency using reserves, gold, foreign exchange, interest rates. But there was one problem with this assumption. The world became more connected than its financial systems were designed for. By the 1960s, global trade exploded. Dollar-denominated bonds were everywhere. Banks in Europe borrowed and lent in dollars. Corporations everywhere from Brazil to South Korea took dollar loans. The strange reality emerged. The world needed more dollars than the United States could physically supply. And every time the world ran short, chaos followed. Currency crises, liquidity shortages, bank runs, sudden collapses in trade and credit. The system was breaking under a silent pressure no one had planned for. This was the environment in which swap lines were born not as a strategy, but as an accident of necessity. The first swap lines quietly appeared in the 1960s, created between the US Federal Reserve and foreign central banks. No speeches, no press releases, no public debate, just quiet agreements between central bankers who realized something alarming. The global financial system needed dollar liquidity faster than the US Treasury or banking system could provide. So the Federal Reserve essentially said, "We will lend you dollars. You give us your currency as collateral. When you're done, you give the dollars back, we give you your currency back." It was simple, elegant, invisible to the public. But this mechanism solved a problem that nothing else could. Foreign banks could now access dollars directly even if private markets froze. The Fed became the lender of last resort to the world, without Congress ever voting on it. Fast forward, the global economy grew larger, faster, and more interconnected. More trade, more capital flows, more dollar debt. By the 1990s, something extraordinary had happened. The US dollar became the world's anchor, not by force, but by demand. Why? Because the dollar had the deepest financial markets, the strongest rule of law, the most trusted central bank, the largest military backing its stability, and, crucially, the swap line system. Other currencies simply couldn't compete. Not even Europe's new currency, the euro. Not even Japan's powerful export economy. Not even China's rising financial dominance. The world had quietly built a dollar-based nervous system, and swap lines were its emergency lifeline. Most people still had no idea this system existed. They wouldn't learn about it until everything nearly collapsed. 2008 was the moment everything snapped. The world had created trillions of dollars in dollar-denominated obligations. But when the crisis hit, dollar liquidity evaporated. Foreign banks couldn't access dollars. Corporations couldn't roll over loans. Entire countries were on the brink of economic cardiac arrest. The Federal Reserve faced a terrifying question. Do we let the global financial system collapse? Or do we open the dollar floodgates? Within days, the Fed activated swap lines with the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank, the Bank of Canada. Then it expanded them, then expanded again. By December 2008, swap lines reached $583 billion in outstanding dollar loans. Think about that. The Fed had lent more dollars to foreign banks than it had ever injected inside the United States. And for the first time, the world realized, the Federal Reserve isn't just America's central bank, it's the world's. Swap lines had become the hidden power behind the dollar, the mechanism that kept the global financial system alive. But the story didn't end there. After the crisis, central banks studied the aftermath. They discovered something deeply unsettling. The global economy was permanently dependent on dollar liquidity. The more the world grew, the more dollars it needed. The more dollars it needed, the more it relied on the Fed. Countries asked, Why do all our global transactions need dollars? Why does the Fed have power over our markets? Why does one nation effectively control liquidity for all nations? But they also asked a more painful question. What happens if the Fed says no? Because swap lines weren't universal. Out of 190 countries in the world, only 5 had permanent, unlimited swap lines with the United States. Let that sink in. An entire nation's financial survival could depend on a phone call from Washington. If the Fed trusts you, you survive. If it doesn't, you're on your own. This was no longer economics, this was geopolitical power. After the 2008 crisis, countries started planning escape routes. Some tried to reduce dollar reliance. Some tried to create alternatives. Some tried to build new alliances. Let's look at the major attempts. 1. Europe's Euroswap network. The European Central Bank built its own version of swap lines. It aimed to make the euro a global reserve currency. It worked, partially. But Europe still relies on dollars for global trade, energy imports, commodities, major cross-border finance. The euro couldn't dislodge the dollar. 2. China and the yuan globalization. China built a massive swap line network with 40 countries. The goal: internationalize the yuan. Progress significant but limited. Why? Because the yuan isn't fully convertible, and global markets still trust us institutions more. China created a parallel system, but it didn't replace the dollar system. 3. The BRICS currency idea. The BRICS alliance, Brazil, Russia, India, China, South Africa announced plans for a new reserve currency, but with conflicting interests, incompatible financial systems, and a lack of unified governance. It remained just that, an idea. The real outcome, despite all attempts, no alternative matched the dollar's depth, the Fed's credibility, the swap line system's reliability, because every alternative lacked one thing: a central bank trusted to provide emergency liquidity to the entire world. Only the Federal Reserve had that, and only the dollar remained indispensable. If you think swap lines were a one-time thing, think again. The pattern repeated again and again. 2020, the COVID crisis, the world froze. Markets collapsed. Dollar funding dried up instantly. The Fed opened swap lines again, this time at a scale even larger than 2008. Trillions in liquidity support. Foreign markets stabilized almost overnight. The dollar's hidden power was confirmed. 2023 SVB, Credit Suisse, and global stress when Credit Suisse approached collapse. When the US banking system showed cracks, swap lines were reactivated weekly. The global dollar pipeline was wide open. What this reveals: every major crisis of the 21st century has the same pattern. 1. The world runs short of dollars. 2. Markets panic. 3. The Fed opens swap lines. 4. The global system breathes again. This is not coincidence. This is dependencies made visible, and it raises a question no one can escape. Most people think the dollar is dominant because it's America's currency, it's used in trade, it's trusted more, it's stable. Those are factors, sure, but the real source of power is deeper. The dollar is dominant because the Fed is willing to supply it to the world even during catastrophe. No other currency has a global emergency backstop. The euro doesn't, the yuan doesn't, the pound doesn't, the yen doesn't, only the dollar. And here's the secret. **** Swap lines act like a global financial alliance. A club, a circle of trust, a geopolitical shield. **** Countries with swap lines are protected. Countries without are exposed. This shapes foreign policy, trade relationships, banking stability, global alliances, even military cooperation. Swap lines are not just a liquidity tool. They are financial diplomacy at its highest level. They decide which countries are inside the system and which remain outside. Here's the part that most viewers will find shocking. The world now holds more than $13 trillion in dollar-denominated debt outside the United States. That means foreign corporations owe dollars, foreign governments owe dollars, foreign banks owe dollars. These entities don't print dollars. So when a crisis hits, when markets freeze, when private lenders vanish, they have only one place left to turn: the Federal Reserve. This is the hidden reason the dollar can't collapse. This is the hidden reason other currencies can't take over. This is the hidden reason the world stays tied to Washington. Because without the dollar, the global financial system doesn't just wobble, it dies. So after all of this, what do swap lines tell us? Let's break it down clearly. Takeaway number 1, the dollar is not dominant. It's indispensable. The global system runs on dollars not because people prefer it, but because the financial architecture requires it. Swap lines prove that the dollar is the world's fail-safe mode. Takeaway number 2, the Federal Reserve holds global influence far beyond US borders. When the Fed acts, the world reacts. Foreign banks, governments, and markets rely on it for survival. No other central bank has this kind of reach or trust. Takeaway number 3. Financial crises reveal the true map of global power. Every crisis exposes the same truth. Countries inside the swap line network are protected. Countries outside are vulnerable. This is the real geopolitical divide of the 21st century. With rising global debt, geopolitical tensions, and rapid financial integration, the next crisis could push swap lines and the dollar system to their limits. Whether the world evolves toward a multipolar currency system or becomes even more dependent on the dollar will depend on how the next crisis unfolds, and it may be closer than we think. If you found this breakdown helpful, if you want more deep dives into the hidden mechanics of global finance, if you want to understand the forces shaping our world behind the scenes, then make sure you subscribe, hit the like button, and share this video with someone who loves economics or global politics. The world of money is complicated, but together, we can uncover it one layer at a time. End.